Welcome to The Drowsy Economist. I'm glad you found your way here tonight. This is our second video together, and if you joined us last week for our exploration of the history of money, welcome back. If this is your first time here, welcome. You've found a quiet corner of the internet where finance and economics are presented not with urgency or excitement, but with the kind of calm, measured pace that invites your mind to settle and rest. Tonight we'll be exploring the global banking system through 100 carefully ordered facts, not with drama or opinion, but simply by walking through how these institutions work, how they're structured, and how they quietly keep the modern economy functioning in the background. If you find yourself learning something along the way, that's wonderful. If instead you find yourself drifting off into peaceful sleep, that's equally wonderful. There is no wrong way to experience this content. Before we begin, if you enjoy this format, these long, calm explorations of financial topics, please consider subscribing to The Drowsy Economist and leaving a like on this video. It helps others discover this space and it supports the creation of more content like this. And now let us turn our attention to banks themselves and begin at the very beginning with the simplest question: what is a bank? Chapter 1. What a bank is. The calm foundation. A bank, at its most fundamental level, is an intermediary. This is our first fact, and it's worth dwelling on for a moment because everything else flows from this basic function. Banks act as intermediaries between people who have money they don't need immediately and people who need money they don't currently have. On one side are depositors, individuals, businesses, organizations who place their funds with the bank. On the other side are borrowers, also individuals, businesses, organizations who need to borrow funds for various purposes. The bank sits in the middle, taking in deposits and using most of those funds to make loans. This intermediation is how banks earn their living. They pay interest to depositors, some small percentage per year on savings accounts, for instance, and they charge interest to borrowers, a higher percentage on mortgages, business loans, credit cards. The difference between the interest paid and the interest received is called the spread, and it's the bank's primary source of revenue. This spread might seem small, perhaps a few percentage points, but when applied to billions or trillions of dollars in deposits and loans, it generates substantial income. Now, our second fact builds directly on the first. When you walk into a bank and deposit, say, $1,000 into your savings account, you might imagine that the bank takes your money, places it in a vault with your name on it, and keeps it there until you return to withdraw it. This mental image is comforting, but it's not how banking works. The bank does not keep your exact cash stored separately. Instead, what happens is this: the bank records a liability to you. On its books, it acknowledges that it owes you $1,000, but the physical cash you handed over, or the electronic transfer you made, becomes part of the bank's pool of funds, which it then uses for lending and investments. This might sound slightly unsettling at first, but it's actually quite practical. If every bank kept every depositor's money in separate storage, those funds would sit idle, earning nothing, doing nothing. By pooling deposits and putting them to work through loans and investments, banks enable money to be more productive. Your $1,000 might help finance someone's mortgage, or a small business's expansion, or a municipality's infrastructure project. And while that money is out working, the bank pays you interest on your deposit, and it has the funds available to give you back your $1,000 whenever you ask for it. This brings us to our third fact, which introduces a term you may have encountered before: fractional reserve banking. Modern commercial banks operate under fractional reserve banking systems. What this means, quite simply, is that banks hold only a portion, a fraction, of deposits as reserves, and they use the rest for loans and other assets. The reserves are the funds the bank keeps readily available, either as vault cash, physical currency stored in the bank's vault, or as balances held at the central bank. But these reserves are only a fraction of total deposits. The rest is lent out. Let us consider the arithmetic for a moment, slowly and carefully. Suppose a bank has $100 million in deposits from its customers. Under fractional reserve banking, the bank might keep $10 million as reserves, 10%, and lend out the remaining $90 million. The exact percentage varies by country, by regulation, by the bank's own policies, but the principle remains the same. Only a fraction is held in reserve. The rest is put to use. This system, fractional reserve banking, is fundamental to how modern economies function. If banks had to keep 100% reserves, if they had to hold every dollar deposited and not lend any of it out, the supply of credit in the economy would be drastically smaller. Businesses couldn't borrow to expand. Individuals couldn't obtain mortgages to buy homes. Economic activity would be constrained by the physical stock of money in existence. Fractional reserve banking, by allowing banks to lend out most of their deposits, effectively expands the money supply and supports economic growth. This sounds unsettling at first, but the system is designed precisely so that depositors do not need to worry about these mechanics. Our fourth fact clarifies what reserves actually are and what they're used for. Reserves consist of vault cash plus balances held at the central bank. Vault cash is straightforward. It's the physical currency the bank keeps on hand to meet withdrawal requests and to stock its ATMs. Balances at the central bank are electronic. Numbers in an account the bank holds with the nation's central bank. These reserves are used mainly for settlement and for meeting regulatory and liquidity needs, rather than backing every deposit one for one. Settlement is a term we'll encounter many times in this video, so let's establish what it means now. When you write a check to someone who banks at a different institution, or when you transfer money electronically to an account at another bank, the two banks must settle that transaction. Your bank needs to transfer funds to the other bank. This settlement typically happens through the central bank. Your bank's reserve balance at the central bank is reduced, and the other bank's reserve balance is increased. Reserves, then, are essential for this plumbing of the financial system, for the daily movement of funds between institutions. Now we come to our fifth fact, which describes something that might seem almost magical when first encountered. When a bank makes a new loan, it typically creates a new deposit in the borrower's account, thereby expanding deposit money in the system. Let's walk through this carefully because it's one of the more counterintuitive aspects of how banking works. Imagine you go to a bank and apply for a loan, perhaps to buy a car or to start a business. Let's say the bank approves a loan of $20,000. You might expect the bank to take $20,000 from its vault or from its reserves and hand it to you. But that's not what happens. Instead, the bank simply credits your account with $20,000. It creates a deposit in your name for that amount. At the same time, it records the loan as an asset on its own books. You now owe the bank $20,000 plus interest to be repaid over time. What's happened here? The bank hasn't taken existing money from somewhere else. It has, in a very real sense, created new money. That $20,000 deposit didn't exist before. Now it does. You can spend it, transfer it, use it just like any other deposit. And when you do spend it, say by transferring it to the car dealer's account, that money becomes a deposit somewhere in the banking system. The total amount of deposit money in the economy has increased. This process, sometimes called credit creation or deposit creation, is how banks expand the money supply. It's not unlimited, of course. There are constraints, which brings us to our sixth and final fact in this opening section. The constraint on lending is usually not a simple reserve ratio, but rather capital requirements, liquidity rules, risk limits, and borrower quality. Reserve requirements, rules about what percentage of deposits must be held as reserves, do exist in some jurisdictions, though many modern banking systems have reduced or eliminated them. But even where they exist, they're not typically the binding constraint on how much a bank can lend. The real constraints are more complex and more subtle. Capital requirements are one major constraint. Banks must hold a certain amount of capital. Equity, essentially the difference between what the bank owns and what it owes, relative to their assets. The riskier the assets, the more capital required. We'll explore this in much more detail later, but for now, understand that capital requirements limit how large a bank's balance sheet can grow relative to its capital base. Liquidity rules are another constraint. Banks must maintain sufficient liquid assets, assets that can quickly be converted to cash, to meet their short-term obligations. If a bank lends out so much that it doesn't have enough liquid assets, it might struggle to meet deposit withdrawals or other demands for funds. Risk limits are internal and external constraints on how much risk a bank can take. A bank might set limits on how much it will lend to any single borrower, or to any particular industry, or in any particular geographic region. Regulators also impose risk limits. These ensure that banks don't concentrate their lending in ways that could lead to catastrophic losses if something goes wrong. And finally, borrower quality matters. Banks don't lend to just anyone who asks. They assess whether borrowers are likely to repay. They look at credit histories, incomes, collateral, business plans. If qualified borrowers are scarce, the bank's lending will be constrained regardless of how much capital or liquidity it has. So, to summarize this opening section gently, banks are intermediaries. They take in deposits and make loans, earning a spread. They don't store your money separately. They record a liability to you and put your funds to work. They operate under fractional reserve systems, holding only a portion of deposits as reserves. Those reserves are used for settlement and liquidity, not to back every deposit. When banks make loans, they create new deposits, expanding the money supply. And their lending is constrained not by reserves alone, but by capital, liquidity, risk management, and borrower quality. These are the foundations, simple concepts perhaps, but essential. And now that we've established what a bank is and how it functions at the most basic level, we can begin to build upward, slowly and steadily. into the structures and systems that keep these institutions stable and functional. Chapter 2. The core safety structure: capital, risk weights, buffers. Now that we understand what a bank is and how it functions at its most basic level, we can turn our attention to what keeps a bank safe. This is a quieter topic than it might first appear. Safety in banking is not about dramatic interventions or heroic measures. It's about structure. It's about buffers. It's about having resources set aside quietly and steadily to absorb losses when they occur, and they will occur. Loans go bad. Investments decline in value. Unexpected events happen. The question is not whether losses will occur, but whether the bank has sufficient cushion to absorb them without failing. This cushion is called capital, and it's the subject of our seventh fact. Bank capital is the difference between assets and liabilities, and it acts as a buffer to absorb losses. Let's think about what this means, slowly and carefully. A bank's assets are everything it owns or is owed: loans it has made, securities it has purchased, cash in its vaults, buildings it occupies. A bank's liabilities are everything it owes: deposits from customers, money it has borrowed from other institutions, bonds it has issued. Capital is what's left when you subtract liabilities from assets. It represents the bank's net worth, the equity held by the bank's shareholders. Imagine a very simple bank with $100 million in assets and $90 million in liabilities. The difference, $10 million, is capital. Now suppose some of the bank's loans go bad, perhaps borrowers default, and the bank loses $5 million on those loans. The value of the bank's assets falls from $100 million to $95 million, but the liabilities remain the same. The bank still owes $90 million to depositors and other creditors. Capital absorbs the loss. It falls from $10 million to $5 million. The bank is still solvent. It still has positive capital. It can continue operating. But suppose the losses had been $15 million instead of $5 million. Assets would fall to $85 million, while liabilities remained at $90 million. Capital would become negative, minus $5 million. The bank would be insolvent. It would owe more than it owns. This is why capital matters. It's the buffer that allows a bank to withstand losses without becoming insolvent. Our eighth fact tells us that regulators require minimum capital ratios, specifically common equity relative to risk-weighted assets, so that banks can withstand unexpected losses. Capital ratios are expressed as percentages. A bank might be required to hold capital equal to, say, 8% of its risk-weighted assets. We'll come to risk-weighted assets in just a moment. But first, let's understand why regulators impose these requirements. If left entirely to their own devices, banks might choose to operate with very little capital. After all, capital is expensive from a bank's perspective. Shareholders expect returns on their equity. The more capital a bank holds, the lower its return on equity for any given level of profit. There's a temptation then to operate with thin capital cushions, maximizing leverage and returns. But this creates fragility. A bank with minimal capital can be rendered insolvent by relatively small losses. And when banks fail, the consequences extend beyond the bank itself. Depositors may lose money. The payment system may be disrupted. Credit to the economy may be curtailed. There are spillovers, externalities, systemic effects. Regulators, therefore, step in and require minimum capital levels. These requirements are designed to ensure that banks hold enough capital to survive even in adverse circumstances. A recession, a financial crisis, unexpected defaults. The requirements vary by jurisdiction and by bank, but the principle is universal. Banks must maintain a cushion sufficient to absorb losses without becoming insolvent. This brings us to our ninth fact, which introduces a concept that will appear many times as we proceed. Risk-weighted assets. Risk-weighted assets adjust a bank's assets by their riskiness, so that safer assets count for less than riskier loans in capital calculations. The idea here is quite sensible. Not all assets carry the same risk of loss. A loan to a stable, credit-worthy corporation is less likely to default than a loan to a speculative startup. A government bond issued by a stable country is less risky than a high-yield corporate bond. Cash and reserves at the central bank carry essentially no risk of loss. Rather than requiring banks to hold the same amount of capital against all assets, regulators assign risk weights to different categories of assets. Cash and central bank reserves might have a risk weight of 0%, meaning they require no capital. A highly rated corporate loan might have a risk weight of 50%, meaning it's counted as half its actual value when calculating capital requirements. A riskier loan might have a risk weight of 100% or even higher, meaning it's counted at full value or more. The process works like this. The bank takes each of its assets, applies the appropriate risk weight, and sums up the results. This gives the total risk-weighted assets. The bank must then hold capital equal to some percentage of that total, say 8%. So if a bank has $1 billion in risk-weighted assets, it must hold at least $80 million in capital. This system encourages banks to hold safer assets, because those assets require less capital, and it ensures that banks hold more capital when they take on riskier exposures. It's a more nuanced approach than simply requiring a fixed percentage of total assets, and it reflects the varying degrees of risk across different types of lending and investment. Now, our 10th fact introduces a complementary measure that some jurisdictions impose: leverage ratios that limit total balance sheet size relative to capital, regardless of risk weights. The risk-weighted approach we just described is sophisticated, but it has a vulnerability. Risk weights can be manipulated either through gaming of the system or through genuine misjudgment about how risky assets actually are. A bank might classify assets as low risk, requiring minimal capital, when they're actually quite risky. To guard against this, some regulators impose a simple leverage ratio, a requirement that capital must be at least a certain percentage of total assets, with no risk weighting at all. Every asset counts at full value. If the leverage ratio requirement is 3%, a bank with $1 billion in total assets must hold at least $30 million in capital, regardless of whether those assets are safe government bonds or risky loans. The leverage ratio acts as a backstop, a blunt but effective tool. It ensures that even if risk weights are too low, even if banks have misjudged the riskiness of their assets, there's still a minimum capital cushion relative to the sheer size of the balance sheet. Our 11th fact tells us that many countries classify some institutions as systemically important banks, which face extra capital and oversight. Not all banks are created equal in terms of their importance to the financial system. A small community bank serving a local region with a few thousand customers is important to those customers and to that community. But if it fails, the broader financial system will barely notice. The bank can be resolved, its deposits transferred to another institution, and life goes on. A large, internationally active bank is different. Such a bank might have trillions of dollars in assets, operate in dozens of countries, provide critical services like payment processing and derivatives clearing, and be deeply interconnected with other financial institutions. If such a bank fails suddenly and chaotically, the consequences could be severe. Other banks that have lent to it might suffer losses. Businesses and individuals that depend on its services might be disrupted. Confidence in the financial system more broadly might be shaken. Regulators have therefore developed the concept of systemically important banks, sometimes called SIBs, or more specifically, Global Systemically Important Banks, or GSIBs. These are institutions whose failure would pose significant risks to the financial system and the broader economy. They face stricter requirements, higher capital ratios, more intensive supervision, more detailed resolution planning. The logic is that if you're systemically important, you must be held to a higher standard, because the cost of your failure would be borne not just by your shareholders and creditors, but by society at large. This brings us to our 12th fact, which addresses a phrase that became infamous during the financial crisis of 2008, too big to fail. The concept of too big to fail led to additional loss-absorbing capacity requirements like TLAC, or total loss-absorbing capacity. The problem with systemically important banks is not just that their failure would be disruptive, but that this creates a kind of implicit guarantee. If a bank is too big to fail, if its collapse would cause unacceptable damage, then the government will likely step in to rescue it. This creates what economists call moral hazard. If a bank's creditors believe it will be bailed out, they don't have as much incentive to monitor the bank's risk-taking, and if the bank itself believes it will be rescued, it might take on more risk than it otherwise would. To address this, regulators have imposed requirements for total loss-absorbing capacity. TLAC requires systemically important banks to hold not just capital, but also certain types of debt that can be converted to equity or written down if the bank fails. The idea is that if the bank gets into trouble, these instruments absorb losses, protecting taxpayers and reducing the need for government bailouts. The bank's shareholders lose their investment, as they should, and certain creditors also bear losses, which gives them an incentive to monitor the bank's behavior. Our 13th fact introduces another type of buffer, counter-cyclical capital buffers, which require extra capital during strong credit growth to absorb losses later. This is a more dynamic form of capital requirement, one that varies over time with economic conditions. The logic is based on an observed pattern in financial crises. During good times, when the economy is growing and optimism is high, credit expands rapidly. Banks lend more. Borrowers take on more debt. Asset prices rise. Everything seems fine. But this credit boom often contains the seeds of the next bust. When the economy eventually slows, when asset prices fall, when borrowers struggle to repay, losses emerge. And those losses can be severe, precisely because so much credit was extended during the boom. Counter-cyclical capital buffers are designed to lean against this pattern. When credit growth is strong and risks are building, regulators can require banks to hold additional capital, perhaps an extra 1 or 2 percentage points above the normal minimum. This serves two purposes. First, it makes banks more resilient, giving them extra cushion to absorb the losses that may come when the cycle turns. Second, it may help moderate the credit boom itself. By requiring extra capital, regulators increase the cost of lending, which may slow credit growth somewhat, reducing the build-up of vulnerabilities. When the downturn comes, when losses materialize and the economy weakens, regulators can release the counter-cyclical buffer, allowing banks to use that extra capital to absorb losses and continue lending. This supports the economy during difficult times. The buffer, in effect, is built up during good times and drawn down during bad times, acting as a kind of shock absorber for the financial system. So, to gather these ideas together gently before we move on, capital is the buffer that absorbs losses. Regulators require minimum capital ratios based on risk-weighted assets. Risk weights adjust for the varying riskiness of different assets. Leverage ratios provide a simple backstop. Systemically important banks face extra requirements because their failure would be especially damaging. Too big to fail problems are addressed through total loss-absorbing capacity requirements. And counter-cyclical buffers vary with economic conditions, building resilience during booms to protect against busts. These are the structural elements that make the banking system safer than it would otherwise be. They're not perfect. They don't prevent all failures or eliminate all crises, but they raise the threshold that must be crossed before failure occurs, making the system more robust and resilient. Chapter 3. Central Banks, the System's Quiet. Plumbing Manager. We've spoken about what banks are and how they're structured to remain safe. Now we turn to the institutions that sit above the banking system, overseeing it, supporting it, and quietly managing the machinery that keeps money flowing through the economy. These institutions are central banks, and they deserve our close attention, because while they rarely appear in headlines during normal times, they are essential to everything we've discussed so far. Our 14th fact establishes the basic relationship. Central banks act as bankers to banks, providing accounts, payments, and short-term lending facilities. This might seem almost circular, banks for banks, but it makes perfect sense when you consider what we learned earlier about settlement. When commercial banks need to transfer funds between themselves, when they need to settle the thousands or millions of daily transactions that their customers initiate, they do so through accounts they hold at the central bank. Think of it this way. You hold an account at a commercial bank. Businesses hold accounts at commercial banks, but commercial banks themselves hold accounts at the central bank. Just as you might transfer money from your account to someone else's account, banks transfer money from their central bank accounts to other banks' central bank accounts. The central bank, in this sense, is the banker's bank. It provides the infrastructure, the accounts, the settlement system that allows the banking system as a whole to function. Central banks also provide short-term lending facilities to commercial banks. If a bank finds itself temporarily short of reserves, perhaps because more deposits were withdrawn than expected, or because payments due to other banks exceeded payments received, it can borrow from the central bank, usually overnight or for a few days. This borrowing is typically secured by collateral, and it's done at an interest rate set by the central bank. The availability of this lending facility is crucial. It means that a bank facing a temporary shortage of funds doesn't have to engage in fire sales of assets or turn away depositors. It can borrow from the central bank, meet its obligations, and then repay the borrowing when its cash position normalizes. Our 15th fact introduces what is perhaps the central bank's most visible and most discussed function. Central banks influence lending conditions by setting policy interest rates, affecting loan and deposit rates across the economy. The central bank doesn't directly control the interest rate on your mortgage or the rate your bank pays on your savings account, but it does set a policy rate, often called the policy interest rate or the base rate or the federal funds rate, depending on the country. And this policy rate influences all other interest rates in the economy. How does this work? The policy rate is typically the rate at which banks can borrow from the central bank overnight, or the rate at which banks lend to each other overnight using their central bank reserves. Because this rate is controlled by the central bank, and because banks can always borrow from or lend to the central bank at this rate, it acts as an anchor for other short-term interest rates. Banks won't lend to each other at rates much different from the policy rate, because they can always use the central bank as an alternative. And once short-term interest rates are anchored by the policy rate, longer-term rates and lending rates throughout the economy are influenced as well. If short-term rates are low, longer-term rates tend to be low, because lenders don't demand much compensation for tying up their money. If a bank can borrow cheaply in the short-term market, it can afford to offer mortgages at lower rates and still earn a profit. Conversely, if the policy rate is high, borrowing costs rise throughout the system. This brings us to our 16th fact. Lower policy rates can encourage lending and investment, while higher rates tend to slow borrowing and loan growth. This is the mechanism through which central banks influence economic activity. When the central bank lowers its policy rate, borrowing becomes cheaper. Businesses can take out loans at lower cost to invest in new equipment, expand operations, hire workers. Individuals can afford mortgages more easily, or can refinance existing mortgages at lower rates, freeing up income for other spending. All of this tends to stimulate economic activity, more lending, more investment, more spending. If the economy is in a recession or growing too slowly, the central bank can lower rates to provide stimulus, to encourage expansion. The effect isn't immediate. Monetary policy works with what are often called long and variable lags, but over time, lower rates tend to support growth. Higher policy rates work in the opposite direction. When the central bank raises its policy rate, borrowing becomes more expensive. Businesses may delay investments if the cost of financing is too high. Individuals may postpone large purchases that require loans. Higher rates also make saving more attractive. Why take risks in the stock market if you can earn a decent return on a savings account or government bond? All of this tends to slow economic activity. If the economy is overheating, if inflation is rising too quickly, the central bank can raise rates to cool things down, to moderate demand and bring inflation back under control. Our 17th fact describes another tool in the central bank's kit: open market operations, through which central banks buy or sell government securities to adjust reserves and short-term rates. Open market operations are a more technical matter, but they're fundamental to how central banks implement monetary policy. Suppose the central bank wants to lower short-term interest rates. It can do this by purchasing government bonds from banks or other financial institutions. When the central bank buys these bonds, it pays for them by crediting the seller's account at the central bank, in effect, creating new reserves. The supply of reserves in the banking system increases. With more reserves available, banks are more willing to lend reserves to each other, and the interest rate on those loans, the short-term rate, falls. Conversely, suppose the central bank wants to raise short-term rates. It can sell government bonds from its portfolio. When banks or other institutions buy these bonds, they pay by having their central bank accounts debited, reducing the supply of reserves in the system. With fewer reserves available, banks charge each other more to borrow reserves overnight, and short-term rates rise. Through these operations, buying and selling securities, adding or draining reserves, the central bank can fine-tune the level of reserves in the banking system and thereby influence short-term interest rates, ensuring they stay close to the central bank's target policy rate. Our 18th fact touches on a requirement that exists in many countries. Banks must hold a minimum reserve ratio, though some systems rely more on other constraints. We discussed fractional reserve banking earlier, the idea that banks hold only a fraction of deposits as reserves. In some jurisdictions, this fraction is legally mandated. A central bank might require that banks hold reserves equal to, say, 10% of their deposits. This is called a reserve requirement or a reserve ratio. Reserve requirements serve several purposes. They ensure that banks maintain a minimum level of liquid assets, which supports financial stability. They can also be a tool of monetary policy. If the central bank raises reserve requirements, banks must hold more reserves, which reduces the amount available for lending, tightening credit conditions. If the central bank lowers reserve requirements, banks can lend more, easing conditions. However, and this is worth noting, many modern central banks have moved away from relying heavily on reserve requirements. Some have reduced them to very low levels or eliminated them entirely. The reason is that reserve requirements can be a crude tool, and there are more flexible ways to manage liquidity and monetary conditions. Our 19th fact addresses one of the central bank's most critical functions, one that becomes especially important during times of stress. Central banks often serve as lenders of last resort, providing emergency liquidity to solvent but illiquid banks. This concept, lender of last resort, deserves careful explanation because it's central to financial stability. A bank can be solvent, meaning its assets exceed its liabilities, it has positive capital, but still face a liquidity crisis. Liquidity means having cash or easily sellable assets to meet immediate obligations. A bank's assets might be largely in the form of loans, which can't be converted to cash quickly without losses. If depositors suddenly lose confidence and rush to withdraw their funds, the bank might not have enough liquid assets to meet those withdrawals, even though it's fundamentally sound. This is the classic bank run scenario. Depositors fear the bank might fail, so they withdraw their money. But those withdrawals force the bank to sell assets at distressed prices, which causes losses, which validates the depositor's fears, which causes more withdrawals. It's a self-fulfilling prophecy. A perfectly healthy bank can be destroyed by a panic. The lender of last resort function is designed to prevent this. If a bank is solvent, if it has good assets and positive capital, but is facing a temporary liquidity squeeze, the central bank can lend to it, providing the cash needed to meet withdrawals and calm the panic. This lending is typically done at a penalty rate, higher than normal market rates to discourage banks from relying on it casually. And it's done against collateral, so the central bank is protected if the bank ultimately does fail. This function was articulated most famously by Walter Bagehot in the 19th century. Bagehot's principle was that in a panic, the central bank should lend freely, at a penalty rate, against good collateral. This provides liquidity to solvent banks, stopping runs before they spiral out of control, while still maintaining some discipline. The lender of last resort function is used sparingly. In normal times, banks don't need emergency liquidity, but during financial crises, when confidence falters and markets freeze, it becomes essential. Central banks have repeatedly used this function to stabilize the financial system during the 2008 financial crisis, during the 2020 pandemic-related stress, and in numerous smaller episodes over the decades. So let us gather these ideas about central banks before moving forward. Central banks are bankers to banks, providing accounts and settlement services. They set policy interest rates which influence borrowing costs throughout the economy. Lower rates encourage lending and growth, higher rates restrain them. Central banks conduct open market operations to manage reserves and implement their rate targets. Some require minimum reserve ratios, though these have become less central to monetary policy over time. And central banks serve as lenders of last resort, providing emergency liquidity to solvent banks during crises. These functions might seem abstract or technical, but they're the foundation on which the modern banking system rests. Central banks don't operate retail branches. They don't advertise on television. Most of the time, their work is invisible to ordinary people, but they're constantly present, quietly managing the system's plumbing, adjusting the levers that control the flow of money and credit, standing ready to intervene when stability is threatened. Chapter 4. The Safety Nets, Preventing Panic, Handling Failure. We've discussed how banks are structured to absorb losses through capital, and how central banks provide support and manage the system's operations. Now we turn to what happens when, despite these precautions, things go wrong, because banks do fail. Not often in well-regulated systems, but it happens. And when it does, or when it threatens to, there are mechanisms in place, safety nets, designed to protect depositors, maintain confidence, and handle failure in an orderly way rather than allowing chaos to spread through the system. Our 20th fact introduces perhaps the most important of these safety nets. Deposit insurance schemes which protect depositors up to a limit if a bank fails, reducing bank-run risk and supporting confidence. Deposit insurance is a relatively modern innovation, though it now exists in most developed economies. The concept is straightforward. The government or a government-backed agency guarantees that if a bank fails, depositors will be made whole up to a certain amount, perhaps $100,000 per account, or $250,000, depending on the jurisdiction. Let's consider what this means for an ordinary depositor. You place your savings in a bank. Without deposit insurance, you're taking a risk. If the bank fails, you might lose some or all of your money. This creates an incentive to monitor the bank's health, but it also creates vulnerability to panic. If you hear that a bank might be in trouble, even if the rumor is unfounded, the rational response is to withdraw your money immediately. Better to withdraw first and ask questions later. This is the logic that drives bank runs, and it's deeply problematic because it means that even healthy banks can be destroyed by rumors. Deposit insurance breaks this dynamic. If your deposits are insured, you don't need to rush to the bank when you hear bad news. Even if the bank fails, you'll get your money back from the insurance fund. The existence of deposit insurance also supports general confidence in the banking system. People are more willing to use banks to keep their money in deposit accounts rather than under mattresses, when they know those deposits are protected. Deposit insurance is typically funded through premiums paid by banks. Each bank contributes to an insurance fund based on the size and riskiness of its deposits. If a bank fails, the insurance fund steps in to pay depositors. In extreme cases, if many banks fail simultaneously and the fund is depleted, the government may back it up with taxpayer money. But in normal times, the system is self-funding. There are limits to deposit insurance coverage, however. The insurance typically applies only up to a certain amount per depositor per institution. This is deliberate. Full unlimited insurance would create moral hazard. If all deposits were guaranteed regardless of amount, large depositors would have no incentive to monitor their bank's health. Our 21st fact describes the phenomenon that deposit insurance is designed to prevent: bank runs, which occur when many depositors withdraw simultaneously out of solvency fears, forcing asset sales or emergency support. We've touched on this already, but it's worth exploring more fully because bank runs are one of the most destructive dynamics in finance. A bank run begins with fear, a rumor, a piece of bad news, a loss of confidence. Depositors become concerned that the bank might fail, and they rush to withdraw their money. The first depositors to arrive can withdraw in full, but as more depositors arrive, the bank's liquid resources are depleted. It must then sell other assets, loans, securities, investments to raise cash. But selling these assets quickly, under pressure, often means selling at a loss. These losses erode the bank's capital. What began as a liquidity problem becomes a solvency problem. The bank's assets fall below its liabilities. It becomes genuinely insolvent, validating the fears that triggered the run in the first place. This dynamic can spread. When one bank fails, depositors at other banks become nervous. Runs can spread from bank to bank, even to institutions that were perfectly healthy to begin with. This contagion is one of the reasons banking crises can be so severe. The response to a bank run, in modern systems with deposit insurance and a lender of last resort, is typically twofold. First, the central bank can provide emergency liquidity. Second, deposit insurance reassures depositors that their money is safe even if the bank fails. Between these two mechanisms, most runs can be stopped before they cause serious damage. Our 22nd fact tells us that many jurisdictions have resolution frameworks to wind down or restructure failing banks in an orderly way. Not every bank that gets into trouble can or should be saved. Sometimes a bank is genuinely insolvent, poorly managed, or engaged in practices that make it unviable. In such cases, the bank needs to exit the market, but how this exit happens matters enormously. Resolution frameworks are legal and regulatory structures that give authorities the power to intervene when a bank is failing, to take it over, and to resolve it in a way that protects depositors and maintains financial stability. This might mean transferring the bank's deposits and healthy assets to another institution while leaving bad assets and losses behind. It might mean restructuring the bank, converting some debt to equity, and continuing operations under new management. Or it might mean winding the bank down completely, but doing so in an orderly fashion over time. The key is that resolution happens under the control of authorities, the central bank, the banking regulator, the deposit insurance agency, rather than through ordinary bankruptcy proceedings. Bank failures are different from ordinary corporate bankruptcies because of their systemic importance and because of the need to protect depositors. Our 23rd fact introduces a specific requirement that emerged from post-crisis reforms: resolution planning, sometimes called living wills, which requires large banks to document how they could be resolved without chaos. The largest, most complex banks operate across multiple countries, have thousands of legal entities, and provide services that other parts of the financial system depend on. If such a bank fails, figuring out how to resolve it in real time, in the midst of a crisis, is extraordinarily difficult. Living wills are an attempt to address this. Regulators require large banks to prepare detailed plans documenting their structure, their interconnections, their critical operations, and how they could be wound down or restructured if they failed. The goal is not necessarily that the plan will be followed exactly. Crises rarely unfold according to plan, but rather that the process of creating the plan forces the bank and its supervisors to understand the bank's structure and identify potential obstacles to resolution. Our 24th fact acknowledges that sometimes the situation exceeds the capacity of normal tools. During systemic crises, authorities may deploy extraordinary measures like liquidity facilities, guarantees, or capital injections. We saw this most dramatically during the 2008 financial crisis, and again during the financial stress at the beginning of the 2020 pandemic. In 2008, the failures and near failures of major financial institutions threatened the entire global financial system. In response, governments and central banks deployed extraordinary measures. Central banks created special lending facilities. Governments issued blanket guarantees of bank deposits and bank debt. And governments injected capital directly into banks, in some cases becoming majority shareholders, to prevent failures and restore confidence. These measures were controversial. They involved using public money to support private institutions. However, policymakers at the time judged the alternative, allowing the system to collapse, to be worse. Our 25th fact observes that historical crises led to reforms strengthening deposit insurance, capital standards, and supervision. Financial crises are terrible to live through, but they do serve one purpose. They reveal weaknesses in the system and create political will for reform. After the banking collapses of the 1930s, the United States established federal deposit insurance and passed significant banking reforms. After the 2007 to 2009 financial crisis, another wave of reforms swept through the global financial system. Capital requirements were strengthened dramatically through what became known as Basel III. Liquidity requirements were introduced for the first time in a comprehensive way. Supervision was intensified. Resolution frameworks were strengthened. These reforms were implemented gradually over several years, and they've made the system substantially more resilient. So let us draw these threads together. Deposit insurance protects ordinary depositors and prevents bank runs. Bank runs driven by fear can destroy even healthy banks. Resolution frameworks provide orderly ways to handle bank failures. Living wills require large banks to plan for their own potential failure. During severe systemic crises, authorities may use extraordinary measures to prevent collapse. And historical crises have repeatedly led to reforms that strengthen the system's resilience. Chapter 5. Global Rules, Basel and Modern Liquidity Regulation. We've discussed how individual banks are structured and regulated, and how safety nets protect depositors and manage failures. Now we turn to something broader and more systematic. The international framework that governs bank capital and risk management across much of the world. This framework is called the Basel Framework, named for the Swiss city where the relevant committee meets, and it has shaped banking regulation globally for more than 3 decades. Our 26th fact establishes the foundation. The Basel Accords are international agreements to harmonize bank capital and risk standards across countries. Before we had these accords, each country set its own banking regulations largely independently. This created problems. A bank operating in multiple countries faced different rules in each jurisdiction. More troublingly, countries faced incentives to keep their requirements relatively loose, to avoid putting their banks at a competitive disadvantage. This was a kind of regulatory race to the bottom. The Basel Accords emerged from a recognition that international coordination could address these problems. If countries agreed on common minimum standards, banks would face more consistent requirements across jurisdictions and the competitive pressure to weaken regulation would be reduced. The Basel Committee on Banking Supervision, established in 1974, became the forum for developing these standards. Our 27th fact takes us to the beginning. Basel I, introduced in 1988, set minimum capital requirements and introduced risk-weighted assets. This was the first Basel Accord. Basel I established that banks should hold capital equal to at least 8% of their risk-weighted assets. The risk-weighting system in Basel I was quite crude. Assets were divided into a few broad categories with fixed risk weights. Cash and government bonds from developed countries had a risk weight of 0%. Mortgages had 50%. Most corporate loans had 100%. This system was simple and easy to implement, but it was also imprecise. It treated all corporate loans the same, regardless of whether they were to stable companies or risky ventures. Our 28th fact describes the next iteration. Basel II expanded risk measurement and introduced 3 pillars: minimum capital, supervisory review, and market discipline. Basel II, finalized in 2004, was far more sophisticated than its predecessor. It attempted to make capital requirements more sensitive to actual risk, and it recognized that regulation needs to be multifaceted. The 3 pillars were designed to reinforce each other. Pillar 1 was minimum capital requirements, similar to Basel I but with much more refined risk measurement. Pillar 2 was supervisory review, recognizing that no mechanical formula can capture all risks. Supervisors need to exercise judgment. Pillar 3 was market discipline, the idea that if banks disclosed detailed information about their risks and capital, market participants could assess the bank's soundness and adjust their behavior accordingly. Basel II was being implemented when the 2007 to 2009 financial crisis struck. The crisis revealed that even Basel II's more sophisticated risk measurement had significant blind spots. This led to the next iteration. Our 29th fact describes the post-crisis response. Basel III strengthened standards after 2007 to 2009, raising capital quality and quantity and adding buffers and liquidity ratios. Basel III, finalized in 2010 and implemented gradually over the following decade, represents the most comprehensive set of banking regulations developed to date. First, Basel III raised both the quality and quantity of capital banks must hold. It tightened the definition of capital, emphasizing common equity, the purest form of loss-absorbing capacity. It also raised the minimum ratios and introduced the capital buffers we discussed earlier. Second, Basel III introduced comprehensive liquidity requirements for the first time. The crisis had shown that banks could be well capitalized but still fail if they couldn't fund themselves during a liquidity crisis. Third, Basel III imposed a leverage ratio requirement, a simple backstop that limits the ratio of assets to capital, regardless of risk weights. Our 30th fact introduces one of Basel III's key innovations, the liquidity coverage ratio, or LCR, which requires enough high-quality liquid assets to cover 30-day stress outflows. The LCR is designed to ensure that banks can survive a short-term liquidity crisis without requiring central bank support. Banks must calculate their expected cash outflows over 30 days given various stresses, deposit withdrawals, funding market disruptions, off-balance sheet commitments being drawn. They must then hold high-quality liquid assets, primarily cash, central bank reserves and highly rated government bonds, sufficient to cover those outflows. This requirement has significantly changed how banks manage their balance sheets. Banks now hold much larger buffers of liquid assets than they did before the crisis. This reduces their profitability somewhat, but it makes them far more resilient to liquidity shocks. Our 31st fact introduces the second liquidity requirement, the net stable funding ratio, or NSFR, which promotes stable funding over a one-year horizon. While the LCR focuses on short-term survival, the NSFR addresses a longer-term structural issue, the maturity mismatch between banks' assets and liabilities. Banks typically make long-term loans but fund themselves with shorter-term deposits and borrowings. The NSFR requires that banks fund themselves with a sufficient proportion of stable funding, deposits and long-term borrowings that are unlikely to be withdrawn quickly, relative to the liquidity profile of their assets. This encourages banks to rely more on deposits and long-term debt, and less on short-term wholesale funding that can evaporate in a crisis. Our 32nd fact returns to Basel II's Pillar 3, market discipline through detailed public disclosures of risk and capital. The idea is that if banks must publicly disclose detailed information about their capital, their risk exposures, their risk management practices, and their financial performance, then market participants can assess the bank's soundness and adjust their behavior accordingly. Pillar 3 requires banks to disclose substantial information on a regular basis, This includes detailed breakdowns of capital, risk-weighted assets by category, exposures to various types of risk, information about how the bank calculates risk weights, and much more. Whether this information actually influences market behavior in the intended way is debated, but the disclosure regime has value simply in forcing banks to organize and present information about their risk positions in a standardized, comprehensive way. Our 33rd fact addresses a technical but important aspect: internal ratings-based approaches, or IRB approaches, which allow banks, with approval, to use internal models to estimate risk parameters for capital purposes. Under the standardized approach, banks use supervisory specified risk weights. The IRB approach allows banks to use their own internal models to estimate risk parameters. The IRB approach is more risk-sensitive than the standardized approach, but it also introduces complexity and the potential for gaming. After the crisis, concerns arose that IRB approaches had allowed banks to hold too little capital. Basel III and subsequent reforms have therefore tightened the requirements for IRB approaches. So let us gather these ideas about the global regulatory framework. The Basel Accords harmonize capital and risk standards across countries. Basel I established the first internationally coordinated capital requirements. Basel II expanded the framework with more sophisticated risk measurement and a three-pillar structure. Basel III substantially strengthened standards by raising capital quality and quantity and introducing comprehensive liquidity requirements. The LCR ensures banks can survive 30 days of stress conditions. The NSFR promotes stable funding over a one-year horizon. Pillar 3 requires detailed public disclosures. And IRB approaches allow sophisticated banks to use their own models, subject to supervisory approval. This framework represents decades of international cooperation and learning from successive crises. It has created a substantially more resilient global banking system than existed before these coordinated standards were developed. Chapter 6. What banks do: business lines and services. We've spent considerable time exploring the structure, safety, and regulation of banks. Now we turn to something more concrete: what banks actually do on a day-to-day basis, the services they provide, the business lines they operate. Our 34th fact gives us an organizational overview. Banks organize into retail banking, corporate banking, treasury, risk, compliance, and operations. This is not a rigid structure. Different banks organize themselves differently, but these broad divisions capture the main functions within a typical bank. Retail banking is what most people think of when they think of a bank. Corporate banking serves businesses rather than individuals. Treasury manages the bank's own funds and investments. Risk, compliance, and operations are support functions. They don't generate revenue directly, but they're essential to keeping the bank running safely. Our 35th fact describes retail banking. It serves individuals and small businesses with checking, savings, mortgages, and personal loans. Retail banking is high volume, relatively low margin business. Each individual customer generates relatively little revenue, but there are millions of customers, and the numbers add up. Checking accounts are transaction accounts. Customers deposit their salaries, pay their bills, make purchases. Savings accounts pay interest and are meant for accumulating funds. Mortgages are among the most important products, large, long-term loans secured by real estate. Personal loans, credit cards and auto loans round out the retail banking portfolio. Our 36th fact describes corporate banking. It provides credit facilities, trade finance, cash management and foreign exchange services for larger business clients. Where retail banking deals with individuals and small businesses, corporate banking serves medium and large companies. Credit facilities for businesses come in many forms: term loans, revolving credit facilities. Trade finance facilitates international trade through instruments like letters of credit. Cash management services help businesses handle the inflows and outflows of funds efficiently. Foreign exchange services are essential for companies that operate internationally. Our 37th fact notes an important structural feature. Many systems separate commercial banking from investment banking, though the degree of separation varies by country. This separation has a historical basis. The Glass-Steagall Act of 1933 in the United States mandated strict separation. Over time, this separation eroded, and Glass-Steagall was repealed in 1999. After the 2008 crisis, there were calls to reimpose strict separation, and some countries did introduce ring-fencing requirements. Our 38th fact describes investment banking. It focuses on underwriting, trading, and advisory, and is subject to extra conduct and capital rules. Investment banking is quite different from commercial banking. Where commercial banks make loans and hold them, investment banks underwrite securities. They help companies and governments issue stocks and bonds. Trading is another core investment banking activity. Investment banks maintain trading desks for various asset classes. Advisory services involve providing strategic advice to companies on mergers, acquisitions, and other corporate transactions. Investment banking is subject to extra regulatory requirements. Conduct rules govern how investment banks interact with clients. Capital rules for trading activities are often more stringent than for lending, and the culture and compensation structures in investment banking differ from commercial banking, tending toward more aggressive, deal-focused approaches. Understanding these business lines helps us see banks not as monolithic institutions, but as organizations performing multiple distinct functions, each requiring different skills and different regulatory oversight. Chapter 7. Payment systems and everyday transactions. If you're still with us at this point, and I genuinely don't know how you would be given our discussions of capital buffers and Basel III, we're entering territory that is, if possible, even more conducive to peaceful rest. We're going to talk about payment settlement and clearing, and then about the everyday mechanics of cards and ATMs. Before we proceed, if you're finding this format helpful, please consider subscribing to The Drowsy Economist and leaving a like. It helps the channel grow. Our 39th fact establishes the foundation. Payment settlement systems move funds between banks by adjusting balances at central banks or clearing institutions. When you transfer money to someone at a different bank, settlement means adjusting the balances that these banks hold at the central bank. Our 40th fact describes one type of settlement system, RTGS systems, or real-time gross settlement systems, which settle high-value payments individually and in real time. RTGS systems are used for large-value payments, payments between financial institutions, large corporate transactions, government payments. These payments may be for millions or even billions of dollars, and the parties need certainty that the payment has been completed. Once a payment settles in an RTGS system, it's done. The funds have moved. There's no possibility of reversal. Our 41st fact describes an alternative approach. Many retail payments use deferred net settlement, accumulating payments and settling in batches. For retail payments, checks, electronic transfers, debit card transactions, immediate real-time settlement is often unnecessary and would be inefficient. Instead, these payments are accumulated over some period and then settled in batches, with only the net positions between banks being settled. This netting dramatically reduces settlement volumes. Instead of settling thousands of individual payments, only the net positions between banks need to be settled. This is more efficient and requires less liquidity. Our 42nd fact introduces the institutions that make this work. Clearing houses or processors which reconcile payment instructions, calculate net positions, and facilitate final settlement. A clearinghouse is an intermediary organization that stands between banks and manages the clearing and settlement process. Banks submit payment instructions to the clearinghouse. The clearinghouse validates these instructions, sorts the payments, and calculates how much each bank owes to every other bank. It then performs netting and facilitates settlement of these net positions. Our 43rd fact addresses risk management. Payment systems have risk controls such as limits, collateral requirements, and queuing mechanisms to keep settlement smooth. Even well-designed payment systems face risks. Payment systems incorporate various controls to manage these risks, limits on how much any bank can owe, collateral requirements, queuing mechanisms that hold payments until conditions permit settlement. Now let's turn to the everyday interfaces, cards and ATMs. Our 44th fact describes a debit card purchase. It routes from the merchant terminal to the acquiring bank, through a card network, to the issuing bank for authorization. Let's walk through this step by step. You present your card at a merchant's terminal. The terminal reads your card information and captures transaction details. It sends this to the acquiring bank, the bank that has a relationship with the merchant. The acquiring bank routes this through a card network, Visa, MasterCard, or another network. The network routes it to your bank, the issuing bank. Your bank receives the authorization request and performs several checks. Does the account exist? Is the card valid? Is there sufficient balance? Are there fraud indicators? If everything checks out, your bank sends approval back through the network. The entire process takes seconds. Settlement, the actual movement of money, happens later, typically at the end of the day in batches. Our 45th fact describes ATMs. They use secure connections and encrypted messages for withdrawals, balance checks, and other actions. When you insert your card into an ATM, the machine reads your card data. You enter your PIN, which the ATM encrypts immediately. The ATM connects to the bank that operates it, or to your bank through secure telecommunications lines. The bank verifies your PIN, confirms your account is in good standing, and checks your balance. Assuming everything is in order, the bank sends approval back. The ATM dispenses cash from its internal vault. All communications are encrypted. Our 46th fact addresses using another bank's ATM. The ATM operator contacts the cardholder's bank via network switches, and banks later settle obligations via interbank mechanisms. When you use another bank's ATM, the ATM doesn't have a direct connection to your bank. Instead, it connects to an ATM network, a switching service that routes transactions between ATMs and banks. The ATM sends your transaction request to its network switch. The switch determines which bank issued your card and routes the request to that bank. Your bank processes it. At the end of the day, all ATM transactions are tallied and obligations are netted and settled through interbank mechanisms. Our 47th fact notes that ATM networks rely on standardized message formats and protocols for interoperability while allowing bank-specific fees and rules. This standardization is essential. Standards define the format of messages, the codes used, the security protocols. The most widely used standard for ATM and card transactions is ISO 8583. These standards allow interoperability. Your card works in many different ATMs, but within this standardized framework, there's flexibility. Each bank can set its own policies about withdrawal limits, fees, and features. Our 48th fact observes that despite digital growth, branches and ATMs remain important for cash, in-person identity verification, and complex requests. For years, observers have predicted the death of bank branches as digital banking takes over. But branches and ATMs haven't disappeared. Cash remains important. ATMs are the primary way most people access cash. Branches serve functions that are difficult to replicate digitally: identity verification, notarizing documents, complex financial advice. Some customers simply prefer personal interaction. So, while the role of branches is evolving, they persist, and ATMs remain relevant even as payment habits shift. This infrastructure operates continuously, mostly invisibly, processing millions of payments every day. If that thought doesn't lull you towards sleep, I don't know what will. Chapter 8: Cross-Border and Internal Operations. Our 49th fact introduces cross-border payments. They often rely on correspondent banking relationships, where banks hold accounts with each other. When you need to send money to someone in another country, your bank operates in your country, but the recipient's bank operates in another country with different payment systems, different currency, different central bank. There's no direct connection. The answer is correspondent banking. Your bank holds an account at a larger bank that operates internationally. That correspondent bank, in turn, holds an account at a bank in the recipient's country. Through this chain of correspondent relationships, payment instructions can be routed and funds can be transferred through a series of account adjustments. This chain can involve multiple intermediaries, multiple currencies, multiple conversions. Correspondent banks charge fees at each step, which is why international transfers are typically more expensive than domestic ones. Our 50th fact introduces the messaging infrastructure. SWIFT provides standardized messaging formats for secure payment instructions and other financial messages. SWIFT, the Society for Worldwide Interbank Financial Telecommunication, is not a payment system itself. It doesn't hold accounts, doesn't settle transactions, doesn't move money. What it provides is a secure, standardized way for banks to send messages to each other. Before SWIFT was established in 1973, international banking relied on telex, telephone, and mail. SWIFT revolutionized international banking by creating a common messaging standard and a secure network. Banks create SWIFT messages using standardized formats, encrypt them, and transmit them through the network. This standardization eliminates ambiguity. SWIFT also provides security. Messages are encrypted in transit. The network uses multiple layers of security controls. Our 51st fact notes that supervisory colleges and cross-border cooperation help regulators oversee large international banks operating in many jurisdictions. A large international bank might have operations in dozens of countries. This creates challenges. No single regulator sees the whole picture. Supervisory colleges are groupings of regulators from the various jurisdictions where a bank operates, brought together to share information and coordinate supervision. The colleges meet periodically to discuss the bank's condition, risk profile, and supervisory plans. Now let's turn inward to the internal machinery of a bank. Our 52nd fact introduces the core banking system. Banks maintain core banking systems that record balances, process transactions, and enforce product rules across all channels. The core banking system is the central database and processing engine for a bank's customer accounts. Every checking account, every savings account, every loan, all are recorded in the core system. The core system maintains the official record of your account balance. When you check your balance through any channel, they're all querying the core system. The core system also enforces product rules. Each type of account has rules and the system automatically applies them. Our 53rd fact describes a critical routine. Core systems run end-of-day processing during which they post interest, apply fees, update statements, and reconcile accounts. Most core banking systems operate on a daily cycle. During the day, they process transactions, but certain activities are deferred until end of day. End of day processing typically begins after close of business. The system goes through each account, applying any interest that's due, applying fees, generating statements, and performing reconciliation. This can take several hours. Our 54th fact introduces the general ledger. Banks maintain a general ledger that aggregates transactions into assets, liabilities, income, and expenses for financial statements. While the core banking system records individual customer accounts, the general ledger provides the bank's overall financial picture. The general ledger organizes information according to the chart of accounts, a structured list of categories. Every transaction processed by the core system is also recorded in the general ledger, following double entry accounting principles. Our 55th fact addresses reporting. Regulatory reporting is extensive, requiring disclosures on capital, asset quality, liquidity, exposures, and off-balance sheet items. Banks are among the most heavily reported institutions in the economy. Regulators require detailed, frequent reports on virtually every aspect of operations. Capital reports detail the bank's capital position. Asset quality reports detail the loan portfolio. Liquidity reports detail liquid assets and funding profile. Exposure reports detail credit exposures to individual borrowers. There are many other reports as well, and large banks may file hundreds of distinct reports annually. Our 56th fact notes that many banks use centralized data warehouses and reporting systems to consolidate information for risk and regulatory reporting. As reporting requirements have proliferated, it has become impractical to generate reports directly from operational systems. Data warehouses consolidate data from multiple source systems into a single repository designed for reporting and analysis. Reporting systems sit on top of the data warehouse, providing tools for defining reports, scheduling production, and distributing them. Our 57th fact describes operation centers. Many banks run centralized operation centers handling routine processing like payments, reconciliations, and document handling. While branches provide customer service, much operational work is performed in centralized operation centers, often in lower-cost areas. These centers process checks, handle incoming payments, process loan applications, and maintain filing systems. The work is repetitive but requires accuracy. In recent years, many banks have automated significant portions of this work. Chapter 9, Risk Management, the Quiet Foundation. If you're still listening, you're learning about the foundations of financial stability. If you've drifted off, that's precisely what this material encourages. Our 58th fact introduces credit risk management. Credit risk teams analyze borrowers, collateral, and prospects using rating models, committees, and documented policies. Credit risk, the risk that borrowers will fail to repay, is the oldest and most fundamental risk in banking. When someone applies for a loan, the bank must evaluate whether to approve it. Credit analysts review the applicant's financial information. For consumer loans, much is now automated with scoring models. For larger loans, analysis is more detailed and individualized. These recommendations typically go to a credit committee, senior credit officers who review proposals and make approval decisions. Each approved loan is assigned a risk rating. Our 59th fact describes ongoing management. Loan portfolios are monitored, loans are classified by credit quality, and provisions are adjusted. Lending doesn't end when the loan is funded. Throughout its life, the bank must monitor the borrower's condition and loan performance. Loans are classified into performance categories: current and performing, past due, non-performing, charged off. The portfolio is constantly reviewed, with problem loans identified and monitored more closely. Our 60th fact explains provisions. Provisions for credit losses anticipate future losses, reducing current earnings but strengthening resilience. Provisions are accounting entries that recognize expected losses on loans before those losses are actually realized. When a bank makes a loan, it knows some percentage will eventually default. Rather than waiting until loans actually default, accounting standards require banks to estimate expected losses and provision for them in advance. Determining appropriate provision levels requires judgment, informed by models and analysis. Provisions reduce reported earnings in the short term, but they strengthen the bank's resilience. Our 61st fact introduces market risk. It comes from changes in interest rates, exchange rates, or security prices monitored via value at risk, sensitivity analysis, and stress tests. Where credit risk is about borrowers failing to repay, market risk is about the value of assets changing due to movements in market prices or rates. Interest rate risk is particularly important for banks. If interest rates rise, the bank's funding costs may increase quickly, while income from existing loans remains fixed. Exchange rate risk affects banks with foreign currency exposures. Security price risk affects banks' investment portfolios. Banks monitor market risk using several tools. Value at risk estimates maximum loss over a specified time period with a specified probability. Sensitivity analysis examines how positions would be affected by specific changes. Stress testing examines extreme scenarios. Our 60-second fact describes liquidity risk management, ensuring obligations can be met using projections, buffers, contingency plans, and funding limits. Liquidity risk is the risk that the bank won't have sufficient cash to meet obligations. Banks manage liquidity by maintaining buffers of liquid assets, projecting cash flows over various time horizons, preparing contingency funding plans, and setting funding limits. Our 63rd fact introduces operational risk, covering process, system, and human failures, errors, fraud, technology breakdowns, managed through controls and incident frameworks. Operational risk is everything that can go wrong that isn't credit, market, or liquidity risk. Mistakes, fraud, system failures. Managing operational risk involves implementing controls, procedures, checks, approvals, segregation of duties. Technology controls are particularly important. When operational risk events occur, banks need incident management frameworks to respond. Our 64th fact describes the 3 lines of defense. Business units manage risks. Risk and compliance functions provide oversight. An internal audit provides independent assurance. This is a widely adopted framework for organizing risk management responsibilities. The first line is business units. They own the risks in their activities. The second line is risk management and compliance functions. They oversee and challenge the first line. The third line is internal audit. It independently assesses whether the first and second lines are working effectively. Our 65th fact notes that internal audit independently reviews controls and compliance, reporting to management and the board. Internal audit operates independently from business units and from risk functions. It reports to the audit committee of the board. Our 66th fact introduces stress testing. Central bank stress tests assess capital adequacy under severe hypothetical scenarios. Stress testing has become a centerpiece of bank supervision since the financial crisis. The idea is to assess whether banks could withstand adverse conditions without failing or requiring government support. Central banks design stress scenarios, severe but plausible economic conditions. Banks project how their balance sheets, income and capital would evolve under these scenarios. The projections show whether the bank would maintain capital above minimums. Our 67th fact notes that model risk management validates and reviews models used for pricing, risk measurement, and capital calculations. Banks use models extensively to price complex instruments, to calculate value at risk, to estimate credit losses. These models are powerful tools, but they're also sources of risk if poorly designed. Model risk management involves validating models to ensure they're fit for purpose. Independent validators review the model's design, test its performance, and assess its assumptions. So let us gather these ideas about risk management. Credit risk teams analyze borrowers using models, committees, and policies. Portfolios are monitored, and provisions adjusted to reflect expected losses. Provisions strengthen resilience by anticipating losses before they occur. Market risk arises from rate and price changes, monitored through VAR, sensitivity, and stress testing. Liquidity risk management ensures banks can meet obligations through buffers, projections, and contingency plans. Operational risk covers failures of processes, systems, and people. The three lines of defense model organizes responsibilities. Internal audit provides independent assurance. Stress tests assess resilience under severe scenarios. And model risk management validates the models banks rely on. This is the boring heart of bank stability. Steady, systematic work identifying and controlling risks. Chapter 10. Compliance, supervision, and structure. If you've made it this far, we now arrive at what might be the most soporific material of all. Compliance procedures, supervisory processes, and structural reforms. Our 68th fact establishes the foundation. Banks must verify identities and monitor activity under KYC and anti-money laundering rules. Know your customer practices prevent criminals from using banks. Banks must verify who their customers are before allowing them to use services. Our 69th fact describes new account opening. Workflows collect identification, screen against sanctions and watch lists, assign risk ratings, and capture tax and regulatory declarations. When someone tries to open an account, the bank must collect identifying information, verify this identification, screen against various watch lists, assign a risk rating, and collect various declarations. All of this happens before the account is even opened. Our 70th fact describes ongoing monitoring. AML rules require monitoring for illegal patterns and filing reports when thresholds or suspicious patterns appear. Once an account is open, the bank must monitor how it's used. Transaction monitoring systems process every transaction, comparing it against rules designed to detect suspicious activity. When the system flags a transaction, a human analyst reviews it. Most alerts are false positives, legitimate activity that happened to trigger a rule. If the analyst concludes activity is legitimately suspicious, the bank must file a suspicious activity report. Our 71st fact explains SRs. Suspicious activity reports are confidential filings. Employees are usually prohibited from informing the customer. When a bank identifies activity that might indicate financial crime, it files a SAR with government authorities. These filings are confidential. The bank is prohibited from telling the customer. Our 72nd fact addresses sanctions compliance. It screens customers and transactions against official lists and blocks, or rejects prohibited transactions. Economic sanctions are restrictions imposed by governments, prohibiting financial transactions with certain individuals, entities, or countries. Banks must screen customers and transactions against sanctions lists. If a transaction matches a sanctioned party, it must be blocked or rejected. Now let's turn to supervision and governance. Our 73rd fact describes banking supervision. It combines on-site examinations, off-site monitoring, and ongoing dialogue on governance, risk, and compliance. Bank supervision is active and continuous. Examiners visit banks and conduct detailed reviews. Supervisors review reports banks submit between examinations. And supervisors maintain regular contact with senior management and boards. Our 74th fact notes that many regulators use risk-based supervision, focusing resources on the largest, riskiest, or most complex institutions. Supervisory resources are limited. Risk-based supervision allocates resources based on the risk institutions pose. Large, complex banks receive the most intensive supervision. Smaller banks receive less intensive but still meaningful oversight. Our 75th fact addresses licensing. Banks must obtain and maintain licenses with authorities reviewing ownership, business plans, capital, and management expertise. You can't simply decide to start a bank. Banking requires a license from the relevant regulatory authority. The application must include detailed information about proposed ownership, a comprehensive business plan, demonstration of adequate initial capital, and identification of the proposed management team. If approved, the bank receives a charter or license. But the license isn't unconditional. The bank must continue meeting requirements. Our 76th fact describes governance requirements. Frameworks define the roles of the board, senior management and committees for strategy, risk appetite, and compliance. Good governance is considered essential for bank safety. At the top is the board of directors, which represents shareholders and has ultimate responsibility. The board approves strategy, sets risk appetite, hires senior management, and oversees major decisions. The board typically works through committees, an audit committee, a risk committee, a compensation committee. Senior management runs the bank day to day, implementing board-approved strategy and managing operations. Our 77th fact notes that remuneration policies face scrutiny to ensure incentives don't encourage excessive risk-taking or short-termism. How bank executives are paid matters for risk-taking. If compensation is heavily weighted toward short-term results, employees may take risks that boost short-term performance but create long-term problems. Post-crisis reforms have imposed requirements on compensation structures. A significant portion must be deferred, paid out over several years. Performance metrics should include risk-adjusted measures, not just gross revenue or profit. Our 78th fact addresses consumer protection. Rules govern fee and rate disclosure, fair lending, complaints, and product marketing. Bank supervision isn't only about safety and soundness, it's also about consumer protection. Disclosure requirements mandate clear communication of product terms. Fair lending laws prohibit discrimination. Complaint handling requirements mandate procedures for receiving and resolving customer complaints. Marketing and sales practice rules govern how banks advertise products. Now let's turn to structural reforms. Our 79th fact introduces ring fencing. Ring fencing and structural separation rules insulate essential retail activities from riskier trading and investment operations. The basic idea is that not all banking activities are equally important to the economy. Retail banking, taking deposits, making loans, providing payment services is essential. Investment banking and trading are arguably less essential. Ring fencing and structural separation are designed to protect retail operations from losses generated by riskier activities. The specifics vary by jurisdiction, but the general approach is to require banks to separate retail from trading and investment activities. The United Kingdom implemented ring fencing following the Vickers Commission recommendations. The United States took a different approach with the Volcker Rule, which prohibits banks that take insured deposits from engaging in proprietary trading. Our 80th fact introduces macro-prudential tools. Central banks and regulators monitor loan growth, asset prices, and leverage, and may use macro-prudential tools like counter-cyclical buffers. Where previous tools focus on individual banks, macro-prudential tools focus on the financial system as a whole. Systemic risks often build up during good times. When the economy is growing, lending expands, standards may erode, asset prices rise, leverage increases. Everything seems fine. But vulnerabilities are accumulating. Macroprudential tools are designed to lean against these cycles. We've discussed countercyclical capital buffers. Other tools include loan-to-value limits, debt-to-income limits, and sectoral capital requirements. Our 81st fact introduces recovery planning. It identifies actions banks can take in stress, asset sales, cost cuts, capital raising, before resolution becomes necessary. Recovery planning is distinct from resolution planning. Resolution happens when a bank has failed. Recovery happens before that point, when the bank is in stress but still viable. Recovery plans are documents banks must prepare, identifying actions they would take if they faced severe stress, selling assets, cutting costs, raising capital. The plans must be specific and credible. Chapter 11, Industry Consolidation and Modern Evolution. Our 82nd fact identifies a primary motivation for bank mergers: economies of scale, spreading fixed costs like technology and compliance over a larger base. Banking involves substantial fixed costs, technology, infrastructure, compliance systems. These costs don't vary much with institution size. This creates a scale advantage for larger banks. If a technology platform costs $100 million per year, a small bank with $5 billion in assets spends 2% of assets on it, while a large bank with $50 billion spends only 0.2%. Mergers allow banks to achieve scale economies by combining operations and spreading fixed costs over a larger asset base. Our 83rd fact describes another motive: geographic or business line diversification, reducing reliance on one market or product. A bank operating only in one region or focusing on one business faces concentration risk. Mergers can provide diversification. A bank in the northeast might merge with one in the southeast, creating geographic balance. Our 84th fact notes a particular scenario. Regulators sometimes facilitate mergers when weaker banks need stronger partners to protect depositors and stability. Not all mergers are driven by business strategy. Some are driven by necessity. When a bank is failing and authorities seek a private sector solution. When a bank is in trouble, regulators may approach healthier banks and encourage them to acquire the troubled institution. These arranged marriages were common during the savings and loan crisis and during 2008. Our 85th fact describes the approval process. Bank M&A is heavily regulated, with multiple applications, public comment periods, and reviews of competition, stability, and community impact. Banks cannot simply decide to merge. The merger must be approved by various regulatory authorities. The acquiring bank must file applications describing the transaction, explaining the rationale, providing financial projections. Regulators review competitive effects, financial stability, management capability, and community impact. The process includes public comment periods. Our 86th fact describes post-merger integration. It harmonizes IT systems, standardizes products, aligns risk policies, and consolidates branches and teams. Getting regulatory approval is only the beginning. The real work happens after the deal closes. Technology integration is often the most challenging aspect. The two banks likely use different core systems. Customer accounts must be migrated, a process fraught with risk. Product standardization is another major task. Risk policies must be aligned. Branch and staff consolidation is inevitable. The integration process typically takes 2 to 3 years. Success is not guaranteed. Some mergers achieve their objectives, others struggle. So let us gather these ideas. Bank mergers aim to achieve economies of scale. Mergers can provide diversification. Regulators sometimes facilitate mergers to resolve troubled banks. M&A is heavily regulated, requiring extensive approvals. And post-merger integration is extraordinarily complex. This consolidation has been a defining trend in banking for decades, reflecting economic forces, regulatory influences, and business strategy. Chapter 12. The Quiet Long Arc, Monetary Evolution. We've travelled through the architecture of modern banking. Now, as we approach the end of our journey, let us step back and consider the longest arc, how money systems themselves have evolved over time. But please consider at this point the details matter less than the broader pattern. Our 87th fact observes one of the most fundamental shifts: the abandonment of the gold standard, which moved systems away from fixed gold convertibility and gave central banks more flexibility. Under the gold standard, a country's money supply was constrained by its gold reserves. Currency was convertible to gold at a fixed rate. The final abandonment of gold convertibility in the early 1970s, when the United States ended the dollar's convertibility to gold, marked a profound change. Money became purely fiat, valuable because governments declared it valuable and because people accepted it, not because it was backed by precious metal. This flexibility has been used, sometimes well and sometimes poorly. Central banks can now respond aggressively to recessions, cutting rates and expanding money supplies. They can provide unlimited liquidity during crises, but they can also create inflation if they expand money supplies excessively. This shift changed banking as well. Banks no longer need to worry about depositors demanding gold conversion. The fractional reserve system operates without the constraint of gold backing, and the relationship between banks and central banks functions in a world of fiat currency. This evolution continues. Central banks are now exploring digital currencies, central bank digital currencies, or CBDCs, that would represent the next step in this progression. Our 88th fact notes that over time, physical cash has become a smaller share of money in many economies, with deposits and electronic payments dominating. In most modern economies, cash is a declining form of money. The vast majority of money exists as deposits, entries in bank accounts, and most payments occur electronically rather than through exchange of physical currency. This shift has implications. As cash declines, banks' role as intermediaries becomes even more central. Nearly all money exists within the banking system. The payment systems we discussed have become the infrastructure through which money moves. The decline of cash also affects monetary policy. Central banks influence the economy primarily through their effect on bank lending and interest rates. As cash becomes less important, this transmission mechanism becomes clearer, and it raises questions about the nature of money itself. When money is physical, its reality is tangible. When money is electronic, it becomes more abstract, more dependent on institutional functioning and trust. Our 89th fact observes that modern banking increasingly relies on technology. Core systems, payment networks, mobile apps, and data analytics. Technology has become central to banking operations. Core banking systems process millions of transactions. Payment networks route payments globally. Mobile apps provide customer interfaces. Data analytics support risk management and marketing. This technological dependence creates both opportunities and vulnerabilities. Banks can serve customers more efficiently, process transactions faster, manage risks more precisely. But they also face cybersecurity threats, operational risks from system failures, and the constant need to invest in technology upgrades. Our 90th fact notes that financial inclusion, bringing banking services to unbanked and underbanked populations, remains a global challenge and opportunity. Despite the sophistication of modern banking, billions of people worldwide lack access to basic banking services. They don't have bank accounts, can't access credit, must rely on cash for all transactions. This exclusion limits economic opportunity. Without bank accounts, people can't save safely, can't receive wages efficiently, can't build credit histories. Financial inclusion initiatives aim to address this through mobile banking, simplified account opening, and alternative credit scoring. Our 91st fact observes that climate-related financial risks are becoming a focus of bank supervision and risk management. Regulators and banks are increasingly recognizing that climate change poses financial risks, physical risks from extreme weather events, transition risks from the shift to a low-carbon economy. Banks are beginning to assess these risks, to consider climate factors in lending decisions, to disclose climate-related exposures. This is still evolving, but it represents another dimension of how banking adapts to changing circumstances. Our 92nd fact notes that fintech companies, technology firms providing financial services, are both competitors and partners to traditional banks. Financial technology has created new entrants providing payments, lending, investment services. Some compete directly with banks, others partner with banks, providing technology platforms or customer acquisition. This has created pressure on traditional banks to innovate, to improve their technology and customer experience. But it has also created opportunities for partnership and for banks to learn from fintech approaches. Our 93rd fact observes that cryptocurrency and blockchain technology represent experimental alternatives to traditional banking, though their role remains uncertain. Bitcoin and other cryptocurrencies operate without central banks or traditional financial intermediaries. Blockchain technology enables distributed ledgers and smart contracts. Whether these technologies will fundamentally reshape banking remains to be seen. They face challenges: scalability, volatility, regulatory uncertainty. But they represent attempts to reimagine how money and financial services might work. Our 94th fact notes that regulatory approaches must balance financial stability with innovation and competition. Throughout our journey, we've seen extensive regulation designed to keep banks safe. But regulation has costs: compliance burdens, reduced flexibility, barriers to entry. Regulators must balance these considerations. Too much regulation stifles innovation and competition. Too little creates instability and consumer harm. Finding the right balance is an ongoing challenge. Our 95th fact observes that banking crises, despite all the safeguards we've discussed, still occur periodically. The 2008 crisis was not the last crisis. Since then, we've seen regional banking stress, cryptocurrency market volatility, pandemic-related financial disruption. Each crisis is different, reflecting new vulnerabilities, new interconnections, new sources of risk. The regulatory reforms we've discussed have made the system more resilient, but they haven't eliminated the possibility of crisis. Our 96th fact notes that international cooperation in banking regulation has grown stronger but faces ongoing challenges. The Basel framework represents successful cooperation, but implementing agreed standards consistently across jurisdictions is difficult. National priorities sometimes conflict with international coordination. Our 97th fact observes that the social purpose of banking, serving the real economy, sometimes conflicts with short-term profit maximization. Banks play an essential role in economic activity, but they're also profit-seeking enterprises. When these objectives conflict, tensions arise. Debates about bank purposes continue. Should banks maximize shareholder returns, or should they balance profit with broader social responsibilities? Different observers reach different conclusions. Our 98th fact notes that bank culture, the values, behaviors, and incentives within institutions, matters as much as rules and capital. We've discussed capital requirements, risk management frameworks, supervisory oversight. But culture, how people actually behave, is equally important. A bank with strong capital but a culture that encourages excessive risk-taking or misconduct will eventually face problems. Regulators increasingly recognize this, paying attention to governance, incentives, and culture alongside traditional prudential measures. Our 99th fact observes that trust in individual banks, in the banking system, in currency itself, remains the foundation on which everything rests. Banking depends on trust. Depositors trust their money will be available when needed. Borrowers trust banks will honor credit commitments. The public trusts that currency retains value. When trust erodes, when depositors panic, when currencies collapse, the system can unravel quickly despite all the structural safeguards. Maintaining trust requires not just sound regulation and supervision, but also ethical behavior, transparency, and accountability. And our 100th and final fact: the global banking system we've explored is not static but continuously evolving, adapting to new technologies, new risks, new economic conditions, and new societal expectations. Everything we've discussed, the capital frameworks, the payment systems, the risk management practices, the regulatory structures, continues to change. New technologies emerge, new business models develop, new risks appear, new crises reveal weaknesses, and the system adapts, reforms, and evolves. This process of continuous adaptation has been happening for centuries, and it will continue for centuries more. And so we arrive at the end of our journey through the global banking system. We began by asking what a bank is, a simple intermediary, taking deposits and making loans. We've traveled through capital structures and liquidity requirements, through payment systems and settlement mechanisms, through risk management and compliance procedures, through supervision and structural reform, through industry consolidation and monetary evolution. 100 facts about how this vast, complex, essential, often boring system actually works. If you've stayed with us through all of this, through discussions of risk-weighted assets and net stable funding ratios and suspicious activity reports, then you possess either remarkable dedication or professional interest in banking minutiae. More likely, you drifted off somewhere along the way, perhaps during Basel III or while contemplating payment settlement, and that's perfectly fine. That's exactly what this content is designed to encourage. If you learned something along the way, wonderful. If you found some comfort in understanding how banks work, how money moves, how the system is structured and supervised and kept safe, I'm glad. And if instead you simply found these explanations soothing, that's equally valuable. This has been the Drowsy Economist. Quiet systems doing essential work mostly unnoticed. If you've enjoyed this format, these long, calm, detailed explorations of financial topics, please consider subscribing to the channel. It helps others discover this quiet corner of the internet. Leave a like if you found this helpful, whether for learning or for sleep. And if there are other topics in finance or economics you'd like explored in this format, feel free to leave suggestions in the comments. The banking system we've explored tonight will continue operating whether you're thinking about it or not. Deposits will be taken and loans will be made. Payments will clear and settle, risk will be measured and managed, compliance procedures will be followed, supervisors will examine, and the system will continue doing its essential, unglamorous work of facilitating economic activity, storing value, and moving money through the economy. Thank you for joining me on this journey. Whether you're still awake or have long since drifted off, I hope you found this time worthwhile. Sleep well, rest easy, and know that while you sleep, the banking system, with all its capital requirements and liquidity buffers, its payment infrastructure and settlement mechanisms, its risk management frameworks and compliance procedures, continues its quiet work, keeping the machinery of modern economic life turning, mostly without drama, mostly without crisis, mostly just doing what it's designed to do. Sweet dreams and good night.